All right, we're live with the Mortgage Podcast. You're with your hosts, Dr. Rick Rock and Bob Nemi, both CMBs. The genesis of this show, we're super excited to have Jim Deitch on this episode of the program, another fellow CMB. And Jim, for your benefit, the genesis of this show really was Bob's. Bob is really the industry champion for the CMB program, as you know, and he was actually, as he just prior to the show reminded me that I'm coming up on my 1-year anniversary of my own pinning that he did for me at the New England Mortgage Banking Conference. But really this is a show for CMBs by CMBs and really for the rest of the industry to gain awareness of the CMB process, and then also to kind of highlight the expertise that really is kind of uniquely held by those who have the CMB designation. So
So definitely, Jim, one of the things we'll want to hear is about your journey.
Why'd you say uh-oh?
You froze for a second. Don't worry. I know it'll correct. I know it'll correct on the live part. But Jim, one of the things I don't know is, when did you get your CMB? What was the moment that made you make that decision? And what have you seen it do for you since you earned it?
Great question. So the genesis of the CMB journey began with Brian Handel, who at the time was my correspondent rep with Wells, and he had pestered me for about a year and a half that you got to do this, you got to do this. So eventually I said, okay. So I went into a study group, went through it, took the test. It's the best thing I ever did because I learned so much about things I didn't know. And the study group for the executive program was really helpful because where I was weak, made some really good connections, learned enough to pass. But it has really been transformational for me in how I think about the industry, how I think the industry can help people grow, and the role of the CMB and the number of CMB members. It's been helpful to me when I reach out for, hey, can you help me with this? It's a fraternity that is really far more than a fraternity. It's more of like a brotherhood, sisterhood thing.
And what year did you earn your CMB?
2009.
2009.
Now, what year did they get rid of the Master CMB?
It was before that, Rick. I don't remember. It's at least 7 or 8 years before mine.
And why did they get rid of it, Bob? Do you know the answer to that?
I think it was just lack of support for the commercial side and lack of interest for people coming up through it. It just kind of fell away. I know there's been a lot of discussion about trying to bring it back. I don't know if they'll be able to do it, but it'd be great. I don't know that's something I'm going to try to step up for, to try to earn a diamond pin. I mean, I've already got the tattoo. I think for me, that's probably enough.
Well, we could tattoo it. We could do a marine pinning and put a diamond in there too.
Please no.
It's interesting, Jim, because one of the comments I made to Bob was, when a local television station or radio station wants to, get a mortgage professional on their show to comment on the market, they end up just calling sort of the local mortgage professional or real estate agent. And the reality is, like in any industry, there's sort of a quality gap between those who are just in the industry versus those who really made this their profession, right? And what I've liked about the CMB program is that it really gives a very unique distinction for those people who have made a very serious commitment to the industry to go deeper. And I agree with you. I've been in this business, 23 years prior to getting the CMB. And I didn't think I needed it. I was kind of like, I've been in this business long enough. Like, man, I have my doctorate. Like, what else do I have to prove? And there was a lot that I felt, that I needed to prove, but as a result of the program, but two, there was a lot that I learned in the program, because in this business, you tend to shy away from the subject matters that you're not very strong in. And the CMB program challenges you to really become subject matter experts, at least enough in each of the core categories that I think are best applied when a television program or a radio station program says, hey, we want to talk to somebody on what's happening in the rate environment today and what consumers should do. To me, they should look for somebody who has their CMB, because I think they're going to get the most competent results and the most competent sort of answers to those critical questions.
That's a great point, because the knowledge test in the 6 areas really gives one the background to at least be competent to talk about the subject, on a 30 or 60-second question posed by a news anchor. But the other thing it does is it allows us to represent the industry and the MBA on the positions that the MBA has taken. And one thing I really learned that was valuable was going through the orals and really understanding those positions and being able to take either side of them to explain them was super helpful. And it really just created an awareness of what the positions are, why they are what they are, and that they're for the good of the industry. So I think from that standpoint, maybe the society can put out a speakers bureau to all the local news agencies, or however that's done. I'm sure there's somebody that has a speakers bureau or an experts bureau, and push the CMB list out. I think it would be a great idea.
Or maybe that's a thing that we get out to individuals, so people who want to do it in certain markets have a format, have a blueprint of how to share as well, and just keep involved. Because you're right, Jim, it is not just that we knew it back when, it's that we're still engaged today. We understand, we're still part of the Mortgage Action Alliance. We're still listening and advocating, on the behalf of our industry. I love what your LinkedIn program, that you're so committed to helping people buy and afford and maintain, their home. It is the core of what
I just put a little note down that says, call the local media and say, hey, if you need an expert, here it is. Here's my CV. Have at it.
Yeah.
So somehow that word has to get out, whether it's larger platforms like the Wall Street Journal or the Fox Business Network or what have you, or CNN, but it's all the local stations. Because obviously real estate is very local, and I think when you have local stations in Western Massachusetts, where I am, or up in Burlington, Vermont, or Des Moines, Iowa, where people just want to understand for the local residents, like what could they do, what available options are for them, or how do you dispel any myths that's within the mortgage industry that might be unique to Las Vegas or Seattle or Spokane or whatever, drawing from a list of CMBs in those local markets would be a really valuable communication tool for the industry, I think.
I think that's a good point. That's a really good point.
So you've seen a bunch of cycles in this business. I mean, you've been in this business really since is it the late 80s or mid 80s is when you started in the business, or was it earlier than that?
It was late 80s.
Late 80s. So, how is this cycle different or the same, would you say? Here you are, you're in the 2020s now, right?
Yeah.
You've seen the 80s, the S&L crisis, you saw the dot-com bubble, you saw the different cycles in the 90s, in the 2000s, and of course the 08 crash. Did we lose you, Jim?
No, I'm still here.
What would you say to be the same and different about this particular cycle? And it looks like we did lose your video, Jim, just as a heads up.
Yeah, bear with me a second.
That's all right.
And by the way, Jim, I got in the business in the late 80s as well. So, we both been around.
Don't understand. It says the camera is connected.
Maybe unplug it from your USB and plug it back in, or were you playing with it? Because sometimes you can there's a little shield over your laptop sometimes.
Let me see if I can get the integrated camera on.
Yeah, I don't think the shield would have it display his image like that.
Let's see here. We are back live. I'm glad that Jim was able to get his camera situation worked out. So, how is the cycle the same or different than what you have seen in the past between the S&L crisis, the real estate crisis in the 90s, then there was sort of the dot-com, sort of economic micro burst, if you will. Then we had the macro burst of 08, and then of course COVID and the cycle since. And then there's all these little microcycles of 2013 and 2018 and so on. So, how is this different and how is this the same?
I think on the macro cycles, it's the first one I've gone through that wasn't credit induced. The S&L crisis, the 05, 06, 07 subprime crisis, all credit induced. Some of the volatility we had in the 2010 to 19 had a little bit of credit in it, but was more interest rates induced. This is a kind of a mega cycle that we had so much liquidity injected into the system, which lowered rates, which pushed so much volume through, which inflated asset prices. And it's the gift that just keeps on giving, and it just won't quit. Kind of recovering from that. And that's why it's different. It's long. It's the first time in my history or memory that we had 5 cycles of loss or 5 quarters of losses. And profitability is still anemic, I guess, by many standards. So this cycle is longer, deeper, harder, and it's one that it's not a recovery that's coming out really, really quickly. So lots of reasons for that, but it's different this time. And I know people say that, but it really is different. I haven't lived through anything like this, starting with COVID and through the liquidity that was injected. So it's just uncharted from my standpoint.
Bob, what's your take on that? Do you think? I mean, you've seen it from a different angle, from the mortgage operator angle, but from the regulatory angle. How do you think that we're in sort of a depressed regulatory environment right now, where it's not really regulatory heightened? You have to imagine that cycle, that pendulum's going to swing eventually, or not. Or do you think?
I would hope that somehow the federal regulatory outlook, the direction, could somehow find its center in the medium, even if it's a little switch. It can't be as wide and politically pushed to the side either direction. Under Trump 1, I thought Kathy Kraninger's version of the CFPB was a good version. They still did enforcement. They were not searching for headlines. They were not just going after people and finding them even though they did something wrong, but not unless it was consumer harm or some reason where they did not make the necessary corrections, remediations, and try to make it good for the consumers. So I would hope for this. It's interesting in the ones that you talked about, the S&L crisis, where maybe there was a little bit of overabundance and lending and lax oversight, and then certainly in the subprime crisis and the great financial crisis that went through, we know a lot of people took advantage. Realtors, borrowers, mortgage brokers, mortgage bankers, banks, the rating agencies, the federal, the reserves, everybody. We got confident in ourselves. We got big-headed. We all looked for money and thought, hey, this is going to last. I will tell you, I was in production all the way up through that. And I saw the back end of the great financial crisis as a mortgage regulator. And it's one of those things that we talk about when I talk to CMBs about just, impacts of different things. I saw a lot of abuses I could not believe. People, making 10, 12 points on a deal and the customer's barely getting enough to pay off the number of 228s or whatever. So financially, it's interesting because some of the years overall where we might have had market changes were some of my better personal production or my team production years back in the day. But it's definitely different. I hope we are beyond a lot of those. I mean, I did see both Joel Kahn, CMB, Marina Walsh, CMB, do presentations in the last month, and they both highlighted charts that showed the top 20% against the bottom 20%. And I know from what we do at WBK, there's still a lot of people looking to merge, looking to change, looking to do different directions to try to reformat their business so they can get back, to the top half of making money, even if it's, not the top 20%.
Yeah, Jim, it's really interesting because I did some consulting in 2010 to 2012 under the Obama administration and the DOJ and some of the investigated mortgage fraud in various sort of target markets around the country. And kind of to your point, Bob, it was incredible. the egregious. I mean, the black and brown communities were completely decimated as a result of this. And so I think that there's. It was predictable that the pendulum was going to swing hard, one way to try to create sort of a very short-term level set of expectations to ensure confidence and to the in the eyes of the consumer. But I'm with you. I think the industry has to be careful what it asks for. If you want a weak CFPB, you're going to get 50 different state regulatory perspectives. So you might have a CFPB that might be punitive, like kind of rulemaking by punitive action or enforcement or clarification by enforcement as to what is to happen, or you get 50 different interpretations of RESPA and what's enforceable and what's not, across 50 different states. I think you have to be really, really careful with what the industry wants. But so I think a good balanced approach is necessary for good, clear administrative guidance. So Jim, you've had some really interesting roles between, CEO of mortgage companies to tech advisor to tech companies to advisor to mortgage companies. Where do you see yourself do you think that your present role in advisory work with specific companies, do you think that really is the way that you can have the broadest impact that you can have on the mortgage landscape as a whole? Or do you think it leading a best in breed mortgage company and sort of growing it through just market adoption?
Yeah, that's a great question. The days I founded 2 national OCC chartered banks, sold them, was involved initially in one that I didn't start, but I ended up having an ownership interest in it. And we sold one to PNC, one to M&T, one to BBT. And I miss the business from that standpoint. Did not miss the crisis going through that and really dealing with the liquidity and some of the fallout. So I do miss the actual lending. We do a little bit of it, here and there, and some capital markets transactions. But I think the opportunity in the current market with what's happening with the vertical integration from first lead to trying to get the mortgage banking process integrated from realtor to mortgage to title the whole way through. So going vertically, I think it's super interesting. Going horizontally and seeing what some of the larger banks are trying to do to use the mortgage product almost as an entry point to affluent and higher net worth individuals, and pricing it as a relationship. And just the whole servicing business, what's come on with HPPA, TCPA, it's going to keep Bob's employer pretty busy for a long period of time. But it's a very interesting thing, and I'd be kidding you if I didn't say, but I've seriously been approached and have talked to some people about getting back in.
Oh, that's interesting. Is that something that you really would entertain?
I think in the right circumstances, yes. Just don't know what those right circumstances are. I'm having a really good time doing what we're doing. My partner Maylene has got some really interesting agentic AI applications that are really being well adopted very fast. But it's a question that I've been out of it for 13 years, so it's like that's a long time to be out of the business. But I've had a couple of inquiries, largely from depositories that say, would you consider this? I haven't said no, haven't said yes. I haven't told anybody that. So this is news.
Yeah, this is breaking news.
This is news to everybody.
Yeah, are banks back? Do you think that, or do you think AI swings the market share more heavily toward IMBs as it's been really since the crash, or not the crash, probably since 2010 or 11, when the pendulum really swung hard to the non-depository route? Do you think the pendulum's going to moderate and swing a little bit more heavily toward banks as a result of AI, or against it?
I don't know if it's a result of AI specifically, Rick, but the regulatory community, particularly the OCC and the FDIC, have signaled that responsible mortgage lending is something there's interest into getting back, from the banks that have largely abandoned the industry. They have taken a much lighter touch on regulation. They've been very clear that they're taking a much lighter touch on regulation, and certainly people that abuse or cause consumer harm or intentionally disregard are going to feel the wrath. But as I talk to people that are in this business in the mortgage banking subsidiary of a bank, it's definitely a lighter touch. I look at some of the banks like M&T and Fifth Third that have gotten back to make a platform investment to get into the business. I think that's a positive sign overall, because those are not small banks, they're not money center banks per se, but I think there's an opportunity in that business for banks, largely because of a lighter regulatory touch if they're directly doing for the bank on the licensing side, and the cost of funds. I mean, the disparity in the cost of funds compared to IMBs is a pretty big number depending on the bank.
Do you think that's more of an accounting flaw, though? Because so much of the bank overhead gets allocated, onto the mortgage side that, like, I often wondered whether or not those costs to close a loan within the bank environment are really comparing apples to apples.
They're not, because if you look at the data and the publicly available data from the MBA, the overhead costs being pushed onto the mortgage banking cost per loan is a big number. From memory, it's around $4,500, and that's just the nature of banks, to take a lot of things that may not even necessarily be used by the mortgage banking unit. And I agree with you, it is an accounting anomaly, because that fixed cost exists no matter what. Most mortgage banking operations have their own compliance, they have their own LOS, they have their own tech support. So that's largely, in my view, an accounting misapplication of distributing that cost. And there's not a good understanding, I think, on the portfolio side, that if you do a portfolio loan, and how you transfer price that portfolio loan is super important to be fair to the mortgage banker and to the bank. I've had discussions with banks on both those topics. I think there's a recognition beginning to say that the cost accounting is being prohibitive to allow the true value of that mortgage transaction and relationship to come forth. At the same time, loosening up a little bit on some of the capital regulations on MSRs may have some positive impact. And lastly, I think when you look at banks that have been effective at using that mortgage, and it's mostly in wealth management and affluent, as a gateway to get wealth management business, to get deposits, to get commercial or near commercial loans, it's an effective strategy. And I have some clients that are doing it, and they're being effective at it, and it's profitable.
I'm glad you brought up the capital, because it's one of my understandings of the Basel Accords and how it was adjusted after the great financial crisis and made it really financially painful for banks to hold the kind of assets that they used to have, and what the risk weightings and everything was to offset with capital and liquidity, and what their balance sheets had to be. So it forced them out. Although, yeah, as you mentioned, regulatory impact, certainly it was a couple of large banks that got hit, and maybe not False Claims Act the best way it should have been used, but understandable. Just hopefully we can get away from that and get the banks back in, not just as the warehouse lenders, not just as the buyers, the investors, but to be actively involved serving their communities as well.
You mentioned regulatory process, and I didn't really consider the impact on the business, but I served in RESPOG in 2010, 11, 12, and along with Dave Stevens and Mike Hyde from Wells Fargo, and we navigated the negotiation of the 50 states attorney general servicing regulations that kind of had their genesis in Richard Cordray's office, but ultimately got implemented across the entire system. And that's the downside. That was a painful process.
Yeah.
It was a process where the guilty, the near guilty, the bystanders didn't matter. You were just getting punished. And it wasn't necessarily the greatest look for the industry. And part of the reason, Rick, that I think a lot of bankers have retreated is it's a long memory of the pain that that looked at. It's a long memory of the the the, the, the regulatory cost, both fines as well as reputational risk that went through it. And you think of what Bank of America essentially endured with the countrywide and what WAMU brought upon the banks. It was not a very good look for banks for a long time. And I think there's still some of that overhang still there about it's a bad business because when you get it wrong, you pay forever and ever. And it's definitely still on people's minds in the boardrooms.
That's fascinating. How obviously there are tools like Redder and other platforms that are out there to kind of help mortgage companies lead with data or lead by the data. How if and I know we're going to be talking about some of these themes, at the Housing Wire Mortgage Banking Conference on October 1st, but like, how is it, or how should a CEO lead an organization today, right? Like, what is it? Is it purely through the data, or do you think is it technology? Can you run an old school mortgage bank that's not necessarily this forward technology sort of platform by just looking at the fundamentals and looking at the metrics? Like, how would you sort of navigate today's waters as a CEO of a mortgage bank?
Are you talking depository or IMB or both?
Let's say IMBs.
Yeah, I think the availability of data from Redder, the other providers, it's just such an incredibly good snapshot of who is productive, who they're working with in the realtor community. It's an amazing data source, and it's really been well curated and made really available by the industry. It takes some of the guesswork out of who's really doing what transactions and with whom. The thing that is fascinating to me is the MBA and that number you mentioned a little bit about the top 20%, the bottom 20%, which the first time I saw that was November 25. And I just looked at that chart and was like, wow, why hasn't this been published before? Maybe it was. It's the first time I saw it. To think about the gap between the top tier and that bottom tier is just incredible. And when you look at it, it's within every company that, thank you, it's within every company that I've looked at, or I've looked at either professionally or just over a beer with a CEO, that it comes out of the lenders that are really doing that 120, 130, 140, 150 of net operating income generally have a really good handle on getting the dispersion between the top performers and the bottom performers pretty tight. The ones that are really at the bottom have a disproportionate number of individuals that just do not meet the performance metrics that the lender would expect to set.
Or that the lender really needs.
That the lender really needs, yeah.
To be in that top tier. So just real briefly, explain this chart. This chart is what really connected you and I, because I picked up the phone and called you and it was like, Jim, it's Rick. That chart that you posted on LinkedIn, this was like almost a year ago, 8 months ago. I was like, that broke the internet, and so explain this particular chart as to why this is so meaningful.
So first of all, there's 3 lines. The green line is the top 20% of the mortgage banking performance report surveys by quarter. And what that top 20% is doing is, at the end of the third quarter of 25, there's about 139 basis points of what that top 20% made. The bottom red line is the operating loss that same 65, 70 lenders at the bottom 20% earned. So they lost 70 basis points. And I coined the term performance gap between the top tier and the bottom tier, and it was almost 200 basis points. It's about 180 today. But if you look back on that chart, those are quarterly observations going back to 2015. And the shape of that chart, meaning there's a big spread between the top and the bottom, and that spread is actually getting wider, is astounding. MBA doesn't release the individual constituents that are in each of those lines, but they don't move a lot. And what was amazing to me is an industry could perpetuate 150, 180, 200 basis points of profit, operating profit between the top tier and the bottom tier. And as you delve into those numbers, there's some causation that is pretty clear that this isn't something that's a fluke. It isn't something that's regional. It is a systemic mindset of how you operate the business.
Yeah, operationally, I do not know how you exist through 2020, 21, 22 and operate at a loss. And it may not be the same entities that are always the bottom 20%, but there's still a group of bottom 20%, and that line just doesn't seem to really go above zero much at all.
It doesn't. And without getting too specific, I mean, I've had friends that have literally liquidated their equity in 21, 22, 23, trying to make it work, but not necessarily understanding it's a different ballgame, and what worked maybe before doesn't work going forward. And in particular, if you look at the ratio of the cost per loan, and my business partner, Maylene, pointed this out to me yesterday. She charted cost per loan and then volume and said, here's what happened in 20 and 21. The whole industry inflated compensation costs. It inflated all the costs of doing business from $8,500, $9,000 to almost $12,000, $12,500. But the volume we're doing is about the same volume we did in 2015, except we're spending almost double the cost to produce it.
So I don't have that chart. That's not this chart here you're talking to, right?
No, it's one that she pulled out of our data tool yesterday and said, look at this. And I that's pretty interesting. So I'll share it with you all. But it really was how the escalation of cost and the components of cost. It's not all in commissions. It's all over the board. And largely it's a large part of it is operational and non-origination, non-sales commission cost. It's sales support, it's operations, it's QC, it's outsourced elements, it's purchase services, it's third-party services. I mean, look what credit reports and the work number charge for verifications. It's a big number, and it's just cumulatively chewing away at the profitability. But it's also a mindset, because you have a choice. I mean, you don't have to carry those costs forever. But there are people that, if you look at one statistic that I remember, and looking at 25 top performers versus bottom performers, is to do about the same number of loans, 4,500 loans. The bottom tier had 50 more people to do the same number of loans. Well, how in the world can you finance 50 people to do the same number of loans of someone that's doing it with 160 people versus 220 people? It's hard for me to get my head around how that kind of sustains itself. But at the same time, Better's lost $2.2 trillion in the last year, so it's
billion, yeah,
be done.
Yeah, go ahead, Bob. I was just going to follow up on that point, but
no, I was just just that number him putting out there, and just some of the headlines and other things going on. I'm just shaking my head.
Yeah, and it's 2.2 billion. I said trillion, I meant billion.
Yeah. The one thing I would
still
say
a big number.
It's a huge number.
But I think what people get wrong with that, Jim, a little bit is what people like Vishal and like Matt Ishbia, what they're trying to do is build a platform to support an entire vertical. It's not just a technology platform to support a single company, right? So to some degree, I have some empathy for their vision. Their vision costs a lot of money, and of course, if they had it their way, everybody would be on Tin Man, or everybody would be on UWN's platform, right? And let's face it, this is how this is sort of how legends are made, right? And when you move an entire industry over to a single operating platform, Calyx did it at one time, and Compass has done it, and in other environments, Apple moved everyone off of BlackBerries back in 2007, 8, 9. So if it works, you're the hero, but when it fails, you're the villain, and you've spent too much money. So it's a really fascinating dynamic, because we're not, at NFM, we're not building technology for 3,000, 4,000 mortgage lenders out there. We're doing it so that NFM can be competitive and the most competitive. But so it's a really different kind of use case and application, and of course, cost model. But what I found interesting about this slide here is that this excludes servicing income, right? So it's easy for people to dismiss this chart because the visceral reaction is, well, of course, the larger lenders are big servicers, and of course they're going to be at 139 basis points net profit versus the bottom's going to be 70 basis points loss and operating loss. It's like that even drives the point even further. And I'd love to update this chart, quite frankly, somehow, or to really highlight this, because I envision us having a chart like this on the where we talk to it for a minute or two behind us while on stage at the Housing Wire, because this should frighten CEOs who don't have an answer to this.
Well, it should certainly motivate, and even on the servicing aspect, whether it includes servicing income or not. I mean, your choice is when you originate the loan, you generate an MSR, you either keep it or you sell it. So it's a timing difference as to whether it's in. And when you look at this over the 10 years or so that's here, servicing almost becomes a nil number, because it's either in there recognized as servicing income over the duration of the loan, or you sold the MSR and took it to profit in the current period. So over that longer period, I think Marina and team are correct just to exclude it, but it's not going to move the number a whole lot because of the accounting for MSRs. That's for our CPAs in the audience.
So what else do you think, as you, because your company Terravede is primarily a consultancy firm, like how would you describe the services that you guys offer mortgage lenders and mortgage vendors?
Yeah, so it's advisory. It is shifting pretty rapidly into the consumption of data with a product that my business partner Maylene has created, which is COE, and it looks at and sifts through all of the data that a lender has and begins to form opinions, agentic opinions, around agents that are looking for clues about origination, operations, compliance, secondary, etc. And it uncovers interesting things about the performance of the lender, such that the insights that are produced and then the documentation that follows, people go, I didn't realize that. And some of them have made some pretty amazing decisions very quickly based on the data, because it's easy to understand. It is not a bunch of charts. They are written insights with data that supports why that insight is important. And more importantly, if you act upon that insight, what's the impact on operating income? So you can look at it, model it, decide to do it or not. And once you see the impact, people begin to act. And that's what's really exciting to me, because as a CMD and a CPA, I can look at things, Rick, you can look at things and see the insights that are there coming off the financials and coming off the operating data, that typically the operators don't have that background or skill set to see. And when you make it simple to see and make it simple to model, people begin to respond to it. And we've seen some remarkable responses with the clients who are using it.
The MBA asked me to speak at the accounting conference that's in November, so I'm looking forward to doing that. And I'm sure you'll be. I'm assuming you'll be there, Jim.
Mm-hmm.
It's arguably one of my favorite conferences, because to me it's the nuts and bolts. I mean, we're bankers. We're supposed to know our numbers, and unfortunately, that's been relegated to the CFO. But with the adoption of like tools that enable financial information, like with AI and Claude and so on, to be able to make financial information a lot more ingestible, and you can manipulate those to in ways that are a lot more visible and tangible to leaders within an organization. I think this is going to be probably the best MBA sort of accounting conference in a long time, and probably one of the most important ones, in light of where the industry is heading in 2027 and 2028. I think it'll be pretty exciting. Who would have thought accounting? Who would have thought the CFO and the accounting practices would be the cool kids in school?
Money matters.
Money matters, and it's cyclical. I mean, you look at that chart, to Bob's point, and see those consistent losses. At some point, you just say, we got to figure this out. And it is a financial and operational accounting issue to figure out.
Yeah, I was just looking at the chart. I do have the one that Marina showed that goes through Q1 of 26, and it's 130 at the top, 16 is the average of everybody, and 95 is the loss at the bottom.
Yeah.
And but the companies that are coming to us looking to align or looking to find somebody for a production team or to merge or to sell or to whatever, they're the people in the middle. They're not the ones at the bottom. And that's the challenge. I just wonder how you make that decision. And obviously there's much more that goes into it, but I've been out. And Jim, you mentioned before that you've considered about coming back. Since I got out in 2012, no. I more production based, more leadership based, just the ups and downs of the market. To me, I like what I get to do at WBK, help out my friends, help people across the country. I'm not an attorney, but I can still advise and then, utilize the great folks we have to get deals done, to find the right partnerships and make sure, help them get it correct with the attorneys and folks we have at Wiener Brodsky Kiter. But anyway.
No, that's incredible.
I don't want to get back into it.
What's interesting is Mitch probably, and Wiener Brodsky Kiter as a whole, to some degree, has never been more relevant because of how disruptive AI is on the enterprise. And being able to ensure that you're using it with caution, with zeal and with caution, is critically important. I would stay real close to your attorney. If you're working with Wiener Brodsky and Kiter,
or any attorney, and that's the one piece of legal advice I do give. If you want to start getting into the gray areas, talk to an attorney. Find somebody that understands it, not somebody who read the rule, somebody who understands the rule from its inception and how it's been enforced, so you know what you're getting into. Because just because we have AI, we have new tools, and we can do things faster, more productive, or whatever. The rules remain the same. The game's still going to be judged by how you play. And if you cross the line too far, you're not checking to make sure you're doing it correctly, it's going to cost you. And I fear for those people. Everybody always asks me when I lead a panel, I ask the leaders, what's keeping you up at night? The one thing that keeps me up at night is that one of my friends' mortgage companies is going to get caught and get dinged because of something that happened, or, they got more aggressive, or so I'm going to do it because I know they're doing it. All bad reasons.
Yeah, well, a shout out to Brian View at Mismo and promoting the frame architecture, because I think it's taking the regulatory opportunity to say, although this may not be a prudential regulator's tool of choice, it does sensitize the industry and creates a framework to go through and document the use of AI, how it's being done, where's the human in the loop, the diligence being done on the models. So I am super appreciative for Brian and team and the MBA's efforts to undertake that. That is, I think, an incredibly timely thing at a really good time to do it.
I echo that 100%.
Well, we really appreciate the time together here, Jim, and I look forward to collaborating with you on these articles for Housing Wire, on really the top questions that CEOs should be asking themselves and answering in order to manage their companies into 2027 and 2028, and then of course the conference in at the Housing Wire conference. So Thank you for being a part of this conversation here, the Mortgage Podcast, and Bob, dude, you're a champ, man. I love doing this with you, and I appreciate your leadership at the CMB.
Enjoy it as well, Rick. I appreciate all the opportunities, and I will say one thing about Jim. If you get an opportunity to meet him or talk to him at a conference, every time I've heard Jim speak, I always know I'm going to learn something. He usually blows my mind with something else, even if it's a sports analogy overlaying the business models. I love it. But Jim is also one of the nicest people I have ever met in this business. I've had the opportunity to meet him at different conferences where we get to spend time together. And Jim is just, one of the people that you should know.
Bob, I really appreciate that. It's very, very kind, and thank you so much. It's great to be with you both. A very, very great experience. So thank you so much.
Thank you, guys.
Thank you, everybody.